Okay, so now let's talk about the fraud triangle and the fraud risk assessment process. And really quick, I want to put this out there. The textbook never really explicitly says this, but fraud risk is a part of risk of material misstatement. It is considered a separate risk from inherent risk and control risk. But even if inherent risk and control risk are low, if you have significant fraud risks associated with a particular account, then risk of material misstatement is high. So just keep that in mind that it is distinct from inherent risk and control risk. It is considered a distinct type of risk. It does also affect RMM. It's not in the model because usually we just identify a limited number of fraud risks per audit engagement. So you're not going to necessarily have one for every single account balance. Okay, so there are generally said to be two main types of fraud: fraudulent financial reporting and misappropriation of assets. So fraudulent financial reporting is our big splashy headline fraud. This is our Bernie Madoff. This is our Enron. It's things like improper revenue recognition, concealing expenses or liabilities. And the reason why this is newspaper headline fraud is because generally the risk of loss is much higher in these cases. So median loss tends to be around $1 million versus misappropriation of assets. This is kind of our everyday fraud. So stealing an entity's assets, things like inventory theft, stealing a company's petty cash. So the dollar values involved tend to be much lower, but this type of fraud is actually much more frequent in organizations. So if we look at this chart, we can see with respect to different types of fraud, financial statement fraud tends to be relatively low percentage, less than 10% of fraud cases, whereas misappropriation of assets tends to represent 80 to 90% of fraud cases. We also see, again, the median loss that I mentioned. So for financial statement fraud, this tends to be really high, like around $1 million. For misappropriation of assets, it tends to be pretty small dollars. And for most of our financial statement audits, the dollar value of asset misappropriation tends to be like less than our tolerable misstatement, far less than overall materialities. So that's why we tend to be not quite so concerned with it very often. And we tend to focus most of our attention around the possibility of financial statement fraud. This is just showing all the different types of fraud. I thought this was kind of a fun chart. So with financial statement fraud, it feels like, hey, there's only 10 types of tricks people can do versus misappropriation of assets. There's, I don't even know how many this is, 20, 30 different types of things you can do. So we have things like inventory theft, fraudulent disbursements. That's basically if somebody at the company cuts a check to themselves. This is actually the only type of fraud I observed in practice. It was a payroll manager cutting payroll checks to herself because there just weren't enough controls and wasn't enough segregation of duties around the payroll process. So it basically enabled her to like set herself up as some fake employee and start cutting checks to herself. There's also lots of different ways you can steal cash. And now we're going to talk about the fraud triangle a bit. I do believe you covered this in AIS, but some of the details might be a little bit different from the perspective of audit. So the fraud triangle, the basic idea here is there are three things that need to be in place in order for fraud to occur. And I kind of like to say it's like how in murder cases, you hear people talking about means, motive, opportunity. For fraud, it's opportunity, pressure, and rationalization. So opportunity is having the actual ability to commit the fraud. This usually means bad controls, people are not watching, bad segregation of duties. This gives you the ability to commit the fraud. Pressure is whatever is coming down on you to make you commit the fraud in the first place. Like most people have an innate desire to be honest, and they're not going to commit fraud just because the opportunity is there. So there needs to be some kind of external pressure forcing them to. So in the case of my payroll manager, she was like a single mom, really struggling, living paycheck to paycheck. So there was a lot of personal financial pressure driving her to want to commit fraud. And then lastly, we have rationalization. So rationalization is all about how you justify your dishonest actions, right? And so you might say, well, the company's just not paying me enough. I'm overworked and underpaid here. So I've got to cut these checks to myself so that I'm getting paid commensurate with the amount of work I'm doing. So now we're actually going to talk about these three legs of the fraud triangle with respect to first fraudulent financial reporting, and then we will have a second set of slides related to the three legs of the fraud triangle for misappropriation of assets. So with respect to fraudulent financial reporting, this slide talks about different types of incentives or pressures that could make you want to commit fraud. So a lot of it is going to be pressure to meet some type of external or third-party expectations. So this could be like analyst expectations. Analysts forecasted you're going to have this EPS for the quarter and you don't want to miss it, right? Because your stock price is going to take a hit. Or maybe your bonus incentives as a manager are tied to hitting analyst forecasts, right? So if you have your executive comp tied to financial performance, that gives you an incentive to commit fraud. If the company is experiencing financial distress, this means you could be like about to trigger loan covenants like we talked about. This gives me incentives to misreport. So the big key here is understanding how management is compensated and evaluated, because those factors generally lead to or create the pressure incentive. Condition 2 is your opportunity needs to be there. And so we talked about how problematic controls tend to be the number one thing that we talk about with respect to opportunities. And if you read through a lot of these, they are also related to poor controls, like ineffective monitoring of management by the board or ineffective monitoring by audit committee. Those are considered basically bad corporate governance, so it's bad entity level controls. Also, opportunities can be created by things like lots of accounting estimates being made by management, right? And so we've historically, it's been shown that certain types of estimates, like the tax provision, the restructuring reserve, and warranty reserve, can be incredibly susceptible to fraud and create opportunities for fraud. And it's basically because these estimates are going to require a lot of judgment. They're going to be subjective estimates. And because of that, it gives management an opportunity to inject bias into the estimates. So if most of these tend to be liabilities, if I want them to be lower, I can make sure I'm biasing certain assumptions so that the ultimate outcome or estimate is lower. And again, this is where things like precision of accounting rules comes into consideration, because you can kind of manipulate your accounting rules, and the accounting rules are creating the opportunity. Same thing with stuff like complex or difficult to understand transactions. So we know this kind of like the transactions around special purpose entities in Enron, those were often considered pretty difficult to understand. And so they kind of could take advantage of those rules. Ineffective internal and external audit also create opportunities. So I won't read all these out to you, but you're fully capable of reading through them on your own. And I think they're all going to make sense as to why they create opportunities for fraud. This slide just lists examples of things that cause weak corporate governance. Remember, weak corporate governance is going to create opportunities for fraud. Now, the auditor should reduce opportunity. We saw on the prior slide that having an ineffective external audit function creates an opportunity, but having a really strong external audit function can close those opportunities. And so things like if you have auditors that are considered higher quality, like Big N or second tier audit firms are considered typically to be higher quality. If you have firms that are industry experts, they tend to be better at preventing and detecting misstatements, so they close off opportunity. Other things said to enhance auditor quality and auditor ability to detect misstatements could be things like having a longer tenure or relationship with the client, because even though this could potentially cause reduced independence, it's actually been found that it generally just creates client-specific expertise that helps you as the auditor do a better job at preventing and detecting misstatements. and less time budget pressure. So of course, the more budget pressure there is, the worse job you're going to do identifying misstatements. And we saw a really clear example of that in the "if you need love, get a puppy" case, because the manager was kind of pressuring our main character there. I can't remember his name. The manager was kind of pressuring him to be like, do we really need to keep looking into this? Because the budget, we don't want to blow the budget. And was just his own kind of professional skepticism, questioning mind and attitude that helped him say, let's put the budget aside and let's really look at this and see what's going on here. Okay, last but not least, rationalization, our third leg of the triangle. So for things like rationalization, obviously it's really hard to see into the minds of management to understand why they're doing what they're doing. But there are certain things that we would consider risk factors where if we notice the presence of this, like if we notice the presence of poor tone at the top, then that's a good indication that rationalization is possible in this organization, right? If you never make your employees sign a code of conduct, then maybe they think it's okay to violate regulations and companies' laws because you never made them sign something saying they couldn't break the rules. Also, if you notice things like this company or these managers have a historical kind of precedent in place where they're okay with violating certain laws as long as it gets results, that tends to be kind of a red flag that they have the capacity to rationalize and they're more than willing to do it. So now let's talk a little bit about the fraud triangle from the perspective of misappropriation of assets, right? So this is kind of, you'll notice it's similar to my payroll manager example where the payroll manager is cutting checks to herself. So example risk factors that could create incentives or pressure could be employees with personal financial obligations or troubles, right? So if I'm living paycheck to paycheck and I'm really worried about money, then that obviously creates incentives for me to steal inventory, cash, make disbursements to myself. Also, things that can create incentive or pressure would be if an employee knows they're being laid off or knows that there's going to be a series of layoffs. Now, this kind of creates to them a personal financial obligation because they know their source of income is going to be cut off. Also, if your employees are being overworked and underpaid. And some of these kind of incentives, also you can see how they're going to create the ability for the employee to rationalize some things. Okay, so opportunities for misappropriation of assets. So this can be things like we said, really bad segregation of duties. Again, once again, we see controls by the opportunities. It could be poor job applicant screening, like maybe you didn't run a background check on your employees before you hired them and they've done this type of thing in the past. Mandatory vacations are another one. You guys are usually very familiar with this concept of mandatory vacations, but this is basically a good control to put in place because oftentimes you'll have some employee and the reason why they don't want to go on vacation is because somebody else is going to have to take over their duties temporarily, and then the fraud would be uncovered. So if you're forcing your employees to take vacations regularly, then that means pretty regularly someone else is going to come over and take on their duties and be able to kind of look at what they've been doing. And lastly, risk factors for rationalization with respect to misappropriation of assets. So this could be, again, if the organization has kind of a general disregard for monitoring and oversight, if the organization has a general disregard for internal controls. So a lot of this can kind of go back to tone at the top, filtering down to the employee level and the individual department level at an organization.